हेलो फ्रेंड्स, वेलकम टू माय चैनल। दिस इज सीए राखी अग्रवाल। आज का हमारा टॉपिक है इंडियन अकाउंटिंग स्टैंडर्ड 33, दैट इज अर्निंग पर शेयर पार्ट 3। Presentation of EPS. How to present EPS in the financial statement. Presentation of EPS is to be done on the face of the profit and loss account. Like in face of the PL, we have to disclose the basic and diluted EPS. We have to disclose the EPS related to continuing operation, also EPS related to discontinuing operation, and the total operation. And in case of diluted EPS calculation, consider only free or bonus element present in the options. So for calculating the diluted EPS, we have to consider the free or elements in which are in option, which we will discuss in the later part of this video. Free element means share issued on exercise of the option. Whatever shares are issued if the entity exercise its option minus number of option into exercise price. So that gets the difference is the free element. Like the total value of put option is 1600 because 160 is the number of options into exercise price, that is 1600, and the average market price of the ordinary shares is rupees 8 per share. So number of share issued is the total value of put option, that is 1600 divided by 8, that is 200 shares, less number of shares received on exercise of option, that is 160. 40 shares are the free element. We will disclose in the presentation of the financial statement. Also, if the option generally do not involve any payout in the form of interest or dividend, hence adjustment to the numerator would generally be nil. If there is no payout in the form of interest or dividends, so no adjustment is required, it will be nil. However, if the option are measured at fair value through profit and loss account, then fair value gain or loss would be adjusted. Means in case the option is does not involve any payout like interest or dividend, then no adjustment is required in the numerator. But if the option are measured at fair value through profit and loss account, and if there is any gain or loss, then it should be adjusted in order to calculate the diluted EPS in the numerator. We have to explain the concept related to discontinuing operation. Discontinuing operation is also presented in the PS. There is a discontinuing operation involved in the along with the continuing operation, then this is the example in which income from continuing operation and discontinuing operation is given, and how to calculate the basic and diluted EPS in both the. So assume the following facts from the company XY. Income from continuing operation is 30 lakhs and loss from discontinuing operation is 36 lakhs. Net loss becomes 30 minus 36, so it becomes net loss becomes 6 lakhs. 6 lakhs is the net loss. Weighted average number of shares outstanding is 10 lakhs. Incremental common shares outstanding related to stock option. If there is a common shares outstanding related to stock option, that is the incremental number of shares is 2 lakhs. You are required to calculate the basic and diluted EPS for the company XY from the above information. So from these information we have to calculate the basic and diluted. And there is another example related to this concept only. If in the above case, in this case the loss from continuing operation is given. In the previous case, income from continuing operation is given 30 lakhs and loss from discontinuing operation is given 36 lakhs. In the next, continuing with the same example, in this case the loss from continuing operation is 10 lakhs and income from discontinued operation is 36 lakhs. So we have to calculate the basic and diluted. In case of part A, that is basic EPS means net profit attributable to the equity shareholder divided by 1 hours, weighted average number of equity shares. So EPS from continuing operation is given in the question, that number of shares outstanding, weighted average number of shares outstanding given in the question is 10 lakh. So basic EPS from continuing operation is 30 lakhs divided by 10 lakhs, so it becomes rupees 3 per share. And also basic EPS from discontinued operation. So there is a loss from discontinuing operation in part A. So there is a 36 lakhs. 36 lakhs is the loss divided by 1 hours, that is weighted average number of shares, that is 10 lakhs. So it becomes 3.6 per share. There is a loss of 3.6 per share. The basic EPS from continuing and discontinuing total operations, that is continuing and discontinuing basic EPS is 3 per share, that is a positive, plus loss is 3.6 per share. So it becomes 0.60 per share, because plus minus it becomes 0.60 per share. Now we will calculate the diluted EPS of part A, that is EPS from continuing operation is 30 lakhs, and we have to give the potential effect in calculating the diluted EPS. 1 hour becomes 10 lakhs, which is we are taking in calculation of basic EPS, but the incremental common shares outstanding related to stock option is also given, that is 2 lakhs. So diluted effect is given for, in order to calculate the diluted EPS is 2.50 per share. So diluted EPS from continuing operation in part A is 30 lakhs divided by 10 lakhs plus 2 lakhs, it becomes 2.50 per share. And EPS for calculating discontinuing operation for diluted EPS is loss of 36 lakhs divided by 10 lakhs plus 2 lakhs, it becomes loss is rupees 3 per share. So total operation from diluted EPS, that is continuing operation and discontinuing operation, becomes 2.50 per share plus loss of 3 per share, so it becomes 0.50 loss per share. Income from continuing operation is a control number. Here the control number, because in case of continuing operation we have to calculate the basic EPS per share, that is rupees 3 per share, and we had calculated the diluted EPS from continuing operation is 2.50. There is a dilution, reduction of EPS from rupees 3 to 2.50. So there is a dilution. Therefore, even though there is an anti-dilution, that is in case of there is a total, in total number there is an anti-dilution, because the loss per share reduced from 0.60 per share to 0.50. So there is a loss per share reduced from 0.60 to 0.50. So in that case it is an anti-dilution, because diluted loss per share 0.50 is reported. In that case what happened, we have to look into, even in the total there is an anti-dilution, because in total from continuing and discontinuing operation the loss is reduced from 0.60 to 0.50. We have to look from the perspective of controlling operation in order to report the diluted EPS. So in that case we have to look into the control number. From continuing operation, the reduction in EPS is from rupees 3 per share to 2.50. So it get diluted. So in that case it should be reported. So we have to, in order to report, we have to look into the controlling number, that is from income from continuing operation. If these give the dilution, then we have to report. Now in part B there is a basic EPS is because in that case loss from continuing operation is given 10 lakhs and income from discontinuing operation is given 36 lakhs. So in part B, basic EPS from continuing operation, there is a loss of 10 lakhs divided by number of shares. 1 hours is 10 lakhs, so rupees 1 per share. And EPS from discontinuing operation is income from discontinuing operation is 36 lakhs divided by weighted average number of shares is 10 lakhs. So rupees 3.6 per share. So total operation, that is from continuing and discontinuing operation, in case of basic EPS is loss of 1 per share plus income of rupees 3.6 per share. So it becomes 2.60 per share. Now diluted EPS. In order to calculate the diluted EPS from continuing operation, there is a loss of 10 lakhs plus dilution effect is given, that is 10 lakhs plus 2 lakhs, that is the incremental number of shares, common stock options. So it gives 10 lakhs divided by 12 lakhs, so it becomes 0.83 loss per share. From continuing operation, in part B, income from discontinuing operation is 36 lakh, and to give the dilution effect, that is 10 lakhs plus 2 lakhs, that is the incremental number of shares. So it gives a profit of rupees 3 per share. So total operation in case of diluted EPS, total EPS in case of dilution. So continuing and discontinuing operation, loss of 0.83 per share plus profit of 3 per share, so it becomes 2.17 per share. Now in that case, what happened? There is a loss of rupees 1 per share from continuing operation, and that loss is decreased from 1 to 0.83. So it gives an anti-dilution effect, because if the profit decreases, then it gives a dilution effect. If the loss decreases, then it gives an anti-dilution. So there is an anti-dilution in calculating the continuing operation, that is the control number. So if the control number loss is decreased from 1 to 0.83, therefore even though there is a dilution in case of total operation, that profit is decreased from 2.60 per share to 2.17 per share, even it gives a dilution effect, it should not be reported, as the income from continuing operation is anti-dilutive in that case. So though the total operation is dilutive in nature, still it will not be reported, because we have to look into from the continuing operation perspective, not from the total operation perspective, in order to report the dilution effect. Contingently issuable shares means these represent shares which are going to be issued in future depending on certain conditions that are going to be fulfilled. Condition that fulfill related to revenue condition and profitability condition. So contingently issuable shares are that shares which are going to be issued in future. That should be represent the shares which are going to be issued in future depending on the fulfillment of certain condition. If the condition that are exist embedded on that issuable shares, if they fulfill that condition, then only the entity will issue in future the number of contingently issuable shares. So that shares are issued in future depending on the fulfillment of certain condition. The condition may be in the form of revenue condition. If the revenue conditions are fulfilled, suppose there is a target of 3 years to give the profits of 200%, then only we will the acquirer company will issue to the acquiree company number of shares is mentioned in the contract, or if the profitability condition is met, then only we will issue the number of shares. If the conditions are fulfilled, then only there is an agreement between the acquirer and the acquiree that if the certain conditions are met, then only we will issue a contingently issuable share. So L&T put condition to the Mindtree that I will not pay you cash on account of acquisition. I will pay you certain shares if the profitability increase by 2 times on account of acquisition. So that condition if the met, then Mindtree will get the shares of L&T. Or if revenue from operation triples on account of acquisition within 3 years from the date of acquisition. If these conditions are fulfilled, then we are going to give you additional number of shares. So these are the contingently issuable shares, means the additional number of shares is given on fulfillment of certain conditions at the time of acquisition. There is a contract between the acquiree, it is an agreement, it is always based on an agreement. What was the implication of contingently issuable shares? In case of basic EPS based on the past information, what was the implication of these shares? If the condition are fulfilled, then what was the implication? Shares should be included in the 1Rs in calculation of basic EPS, the additional number of shares is included in the VANAs. From the date of the condition are fulfilled, the shares become issuable. Means when the conditions are fulfilled and the shares are issued, are inclusion of VANAs in order to calculate the basic EPS. In case of diluted EPS, what happened? Estimates means we have to estimate. Forward looking estimates are prohibited in financial statement as far as EPS is concerned, because we can't calculate an EPS on the basis of estimation. So what we will do, eliminate forward estimates. Shares are to be included in the current year as potential equity share only. If they have a potential to convert into shares, only that interest is to be, that element is to be included only if the shares are issuable, considering the current period to be the end of the contingency period, and the potential shares will be included from the date. From which date it should be included? From the date of contingent shares agreement, from the which date the agreement is made, or beginning of the year, whichever is later. So potential shares are included in the VANAs from the date when the agreement is prepared or the beginning of the year. दोनों में से जो बाद में आएगा. Prior period restatement is not needed. So we will explain this concept, contingently issuable shares, with the help of example. Suppose illustration, ordinary shares outstanding during 2021 is 10 lakhs. There were no options, warrants or convertible instruments outstanding during the period. An agreement related to recent business combination provide for the issue of additional ordinary shares based on the following conditions. In case of business combination has made the acquirer and acquiree, there is an agreement between them for issue of ordinary shares. They will issue an additional number of shares on fulfillment of certain conditions. What the acquirer company will issue if the acquiring company fulfill the certain condition? There is a retail sites open during 2021. They have to open retail sites. If they open retail sites, then 5,000 additional ordinary shares for each new retail sites open during 2021. एक साइट आप रिटेल साइट ओपन करोगे अगर, तो आपको 5,000 एडिशनल नंबर ऑफ शेयर्स, 1,000 additional ordinary shares for each of rupees 1,000 of consolidated profits in excess of 20 lakhs. अगर आपका profits consolidated profits 20 lakhs से increase होता है, तो for every 100,000 shares additional 1,000 number of shares is to be given as bonus for ending on 31st December 2021. So consolidated year to the date profit attributable to the ordinary equity shareholder of the parent entity is rupees 11 lakhs as on 31st March 2021, rupees 23 lakhs as on 30th June 2021, rupees 19 lakhs as on 30th September 2021, including 4,50,000 loss from discontinued operation, and rupees 29 lakhs as on 31st December 2021. So we have to calculate the basic EPS and diluted EPS in an annual concept way and also in quarterly way. So firstly we will calculate in an annual concept way, because in these question the financial year is from 1st January to 31st December. So taking into consideration the financial year from 1st January to 31st December, we will calculate this on an annual way. So date of contingent shares agreement assumed to be at commencement of the year. So we will take the agreement on the commencement of the year, that is on 1st January 2021. There is some conditions put on by the entity, that is contingency condition, that is retail condition. First condition is opening of retail sites. When satisfied, when store is open, need not operate for the entire year. Means when store is open, that is enough to fulfill the retail condition. Earning condition is profit for the year as a whole, satisfy at the end of the year. So firstly we will calculate the basic EPS. We will take the consolidated profit as on 31st December 2021, because the year-end profit is 29 lakhs. Then we will give the effect of basic EPS in order to calculate the denominator, that is 10 lakhs is the outstanding shares without giving the effect of warrants or convertible instruments. So 10 lakhs into 12 divided by 12 for the whole year, plus we have to give the, because retail site opened during 2021, one site on 1st May 2021 and another one is on 1st September 2021. So one site is additional number of shares given by the entity is 5,000 for each new retail site. So one site is open on 1st May, 5,000 into May, June, July, August, September, October, November, December, 8 months. So 5,000 into 8 divided by 12, and another site is open on 1st September, October, November, December, 4 months. So 5,000 into 8 by divided by 12 plus 5,000 into 4 divided by 12. So basic EPS is 29 lakhs divided by 10 lakh 5,000. So it becomes 2.89 per share. See, the effect of retail contingency is given on calculation of basic EPS. Now we will calculate the diluted EPS. How we will calculate the diluted EPS? 29 lakhs, that is the profit attributable to the equity shareholder, divided by the 10 lakh 5,000, that is the 1 hours for basic calculation which we had considered in our basic calculation. That number of shares, that is 10 lakh 5,000 number of shares for the whole year, that is 12 by 12, plus we will consider for the retail store which is opened on 1st May. So these are the calculation for diluted EPS. So we will take the potential, they have a potential to convert. So 5,000 from, we will consider the date of agreement or start of the year, whichever is later. So in this case both are the same, so we will consider from the beginning of the year, that is from 1st January 2021 to 1st May, that is the date when the retail site was open, that is on 1st May 2021. So it is for a period of 4 months, that is January, February, March, April, for 4 months. So 5,000 into 4 divided by 12. Then another outlet site was opened on 1st September 2021. The potential shares is 5,000 into, for a period from 1st January 2021 to 31st August 2020. We had considered that they have a potential to convert. So from 1st January 2021 to 31st August 2021, for a period of 8 months. So 5,000 into 8 divided by 12. Now we will take the effect of earning contingencies, that is having the number of shares that is in excess of 20 lakh profits. In this case the profits is 29 lakhs, so 9 lakh number is the profits. 29 lakh minus 20 lakhs into 1,000 divided by 1,000, so it becomes 9 lakh. So running number of shares is 9 lakh number of potential shares. So 29 lakh divided by 10 lakh 5,000 plus 5,000 number of shares, 5,000 into 4 divided by 12 plus 5,000 into 8 divided by 12 plus 9 lakh shares. So it becomes 19 lakh 10,000 shares. So 29 lakh divided by 19 lakh 10,000. So it becomes 1.52 per share. So as the diluted EPS, in this case the diluted EPS is lower than the basic EPS. That is 1.52 is lower than 2.89 per share, hence it should be reported. It is a case of dilution because diluted EPS is less than the basic EPS, so it should be diluted and it should be reported. In this way we will calculate the annual impact. Retail contingencies and earning contingencies conditions are fulfilled in order to calculate the basic and diluted EPS. Now we will give the quarterly profits and quarterly calculation of basic and diluted EPS. Now in this case the quarterly profits are given, that is on 1st January to 31st March the profit becomes 11 lakhs. Quarter 1 the profit is 11 lakhs. Now from as on 30th June 2021 the profit becomes 23 lakhs which include 11 lakhs. So we have to determine only the quarter 2 profit, that is 23 lakhs minus 11 lakhs. So the quarter 2 profit becomes 12 lakhs. Up to September the profit becomes 19 lakhs, which also includes the 4 lakh 5,000 loss from discontinued operation. So only quarter 3 profits becomes, because 19 lakhs is the profit for the up to September, and 23 lakhs is the profit up to the second quarter. So we have to reduce to get the quarter 3 profits. So quarter 3 there is a loss, and in quarter 4 up to quarter 4 means the whole year profit is 29 lakhs. We have to determine the quarter 4 profit only. So 29 lakhs minus 10 lakhs. So 10 lakhs is the profit related to quarter 4. Now we have to calculate quarterly the basic and diluted EPS. In quarter 1 the basic EPS is, because the quarter 1 profit is 11 lakhs. In quarter 1 the number of shares is 10 lakhs, but there is no contingency effect is given in quarter 1 because the store is open in from 1st May, which falls on the second quarter. Profit they does not meet the criteria of 20 lakhs to get the earning contingencies. So both the contingencies are not fulfilled in quarter 1. So the basic EPS become 11 lakhs divided by 10 lakhs plus nil because the contingencies are not fulfilled. So it becomes 1.10 per share in quarter 1. In case of diluted EPS, the same calculation, because the contingencies effects, the dilution effects are not given in the denominator because they do not fulfill the condition. So 11 lakhs divided by 10 lakhs, so it becomes 1.10 per share. In quarter 2 the profit becomes 12 lakhs, but in quarter 2 the contingencies conditions are fulfilled because on 1st May the retail sites are open, so they will give the effects of 5,000 shares in the denominator, that is 12 lakhs divided by 10 lakhs, that is the 1 hours for basic outstanding number of shares plus retail site open. Retail contingencies are 5,000 shares for a period because April, May, June, and the site is open on May. So we will give the effects of 2 months only. So 5,000 into 2 divided by that is May and June. 5,000 into 2 divided by 3 because the quarter is for 3 months. So we will give 12 lakhs divided by 10 lakhs, 3,333. So the basic EPS in quarter 2 becomes 1.20 per share. Now diluted, in case of diluted EPS, what happens? 12 lakhs is there, and the basic denominator becomes basic 1 hours. In quarter 2 we had determined, that is 10 lakh 3,333 plus. They have a potential effects of retail contingencies are 5,000 for 1 month because April there is a potential contingencies. So 1 divided by 3 in case of diluted EPS. So for 1 month, for the month of April, the effect is given 5,000 into 1 by 3 because May and June effects are already taken in the calculation of 10 lakhs 3,033. We have to give the effect of 1 month, 5,000 into 1 by 3 plus profit contingencies in quarter 2. The profit in excess of 20 lakhs, that is in quarter 2 the profit becomes 23 lakhs. So in this case the 3 lakhs is the in excess of 20 lakhs. So profit contingencies effects is given in diluted EPS 3 lakhs into 3 divided by 3 because 3 months divided by 3 months. So it becomes 12 lakh divided by 13 lakh 5,000. So it becomes 0.92 per share. Now in quarter 3 what happened? Quarter 3 there is a loss of 4 lakhs. So rupees 4 lakhs divided by 10 lakhs, that is the basic 1 hours plus 5,000 shares. Retail store open on quarter 2, that is for 3 months, 3 into divided by 3 plus the retail store opened on quarter 3, that is on 1st September 2021. So 5,000 into, because it is open on September, that is the end of quarter 3, This is July, August, September. So it will be for 1 month. So 1 divided by 3. So total EPS for quarter 3 is loss of 4 lakhs divided by 10 lakhs 6,667 number of shares. So it becomes basic EPS becomes in loss, that is 0.3973 per share, and diluted EPS in quarter 3 becomes loss is 4 lakhs divided by the number of shares which is calculated in basic EPS, that is 10 lakhs 6,667 plus the potential shares for retail store opened on quarter 3, that is on September, because it is actually we are taken for 1 month and potentially they have a potential of 2 months. So 5,000 into 2 divided by 3, plus there is no earning contingencies. So it becomes loss of 4 lakh divided by 10 lakh 10,000 shares. So it becomes rupees 0.396 in loss per share. Quarter 3 profit from continuing operation. So there is a profit of 50,000 because quarter 3 includes a loss of 4,50,000 from discontinued operation. So there is a profit. How it is? There is a profit 19 lakhs plus 4 lakh 50,000. So there is a 23 lakh 50,000 because 19 lakh includes a loss from discontinued operation. So total profit in quarter 3 becomes 23 lakh 50,000, out of which the 23 lakhs is the profit up to 30 June. Actual profit during the quarter 3 becomes 23 lakh 50,000 minus 23 lakhs, so 50,000 from continuing operation. So 50,000 divided by 10 lakhs 6,667 shares in calculating the basic EPS, so it becomes 0.04967 per shares. And in case of diluted EPS, 50,000 divided by 10 lakh 10,000 shares, that is controlling number, so it becomes 0.0495 per share. Because the loss during the third quarter is attributable to a loss from a discontinued operation, the anti-dilution rate do not apply. The control number, that is the profit or loss from continuing operation attributable to equity holder of the parent entity, is positive. Accordingly, the effect of potential ordinary shares is included in the calculation of diluted earning per share. So because the loss during the third quarter, there is a loss during the third quarter is also attributable to the loss from discontinuing operations. So anti-dilution rule do not profit from continuing operation, that is the controlling number, because we have to check the profit from controlling operation, and the profit is decreases 0.496 to 0.495 per share. So it was in dilution. Profit from the controlling number is in dilutive nature, and the total profit is anti-dilutive because the loss 0.3973 is decreased from 0.396 per share. So because the loss during the third quarter is attributable to the loss from discontinuing operation, the anti-dilution rule does not apply. In this case, the anti-dilution rule does not apply. The controlling number, that is the profit or loss from continuing operation attributable to the equity holder of the is positive. Accordingly, the effect of potential ordinary shares is included in the calculation of diluted earning per share. So this calculation is to be reported. Now quarter 4, there is a basic EPS is 10 lakh divided by 10 lakh plus 5,000 plus 5,000 for retail. For earning contingencies is not included in this. So only the retail contingencies is included in basic EPS. 10 lakhs divided by 10 lakh 10,000, so it becomes 0.99 per share. In case of diluted EPS, 10 lakhs divided by 10 lakh 10,000, that is Vanas related to basic EPS plus 9 lakh because contingencies, earning contingencies in excess of 20 lakhs in quarter 4 is 9 lakhs shares. Number of 9 lakh number of shares because number of profits are 29 lakhs, and in excess of 20 lakhs, that is 9 lakhs. So number of shares for every 9 lakhs, 1,000 shares. the additional 1000 shares is to be given. So 9 lakh shares for 3 months divided by quarter 3, so it becomes 19 lakh 10,000. So 10 lakh divided by 19 lakh 10,000, so it becomes rupees 0.526 per share. Now we will discuss about the concept related to financial instrument and how to calculate EPS in case of financial instrument. Before going further, we related to how what is compound instrument. Compound, just a concept related to compound financial instrument because there is a separate index for that. Index 109, Index 107, Index 32 for the financial instrument. So we will already discuss this index. If anybody wants to get the detailed discussion about the financial instrument, they can check out that video. But today we are just going to discuss the financial instrument for calculating the EPS. Compound financial instrument, which means that is convertible debentures or preference shares. They have a option to debenture and preference shares into a shares. Compulsory convertible means there is no obligation to deliver cash. In that case, that is compulsory convertible into share. There is no option to deliver the payment in cash. Had to settled at fixed number of equity instruments. Treat it as an equity, not as a liability component. So compulsory convertibles are equity component. They don't have a liability component because there is no obligation to deliver cash. They are settled at a number of optionally convertible means they have an option in the holders have an option that they will either ask for to the issuer for cash or for equity. Holder has an option to convert their instruments whether in equity or they will settle their liability in cash. So principal nature of financial liability, they have a nature of financial liability because they are optionally at the option of holders demand. So they generally it will be treated as financial liability because holders can demand cash also. So these financial liability having an embedded derivative means they have an embedded equity instrument on that. Optionally convertible at the issuer's option means issuer have an option whether to give equity instrument or give treat it as a liability. So issuer has an option, so generally it will be considered as an equity. But if in any cases alternatively if the management has no intention to convert, then treat as financial liability for redemption. So these are the basic concepts. Now we will discuss how it is impacted on EPS. So if the market rate of similar non-convertible debenture is given in the question, if the market rate of similar non-convertible debenture is given in the question, determine liability and equity component. Then you have to determine the liability and equity component. Firstly, what you will do, add number of shares on conversion denominator. In denominator, add the number of converted shares, not equity component. And in the numerator, you have to add interest, which is a liability component, that is liability component into effective interest rate. You do not need to add the coupon interest as it is not a finance cost but a payout. Coupon interest is not a finance cost but a payout, but you have to add that interest which is a liability component multiplied with the effective interest rate. So this concept we will explain with the help of example. So this is the example. So this concept is explained with the help of examples. Suppose an entity issued 2000 convertible bond at the beginning of year 1. The bond have 3 years term and are issued at par with a face value of rupees 1000 per bond. The number of bonds are 2000, face value per bond is 1000 and term of bond is 3 years. Now the total proceeds becomes 2000 into 1000, so an interest is payable annually in arrears at a nominal annual interest rate of 6%. So interest rate coupon rate is 6%. Each bond is convertible at any time up to maturity into 250 ordinary shares. Convertible bond, the bond is convertible into shares. Each bond is converted at any time at maturity 250 ordinary shares. The entity has an option to settle the principal amount of convertible bond in ordinary shares or in cash. So it is at the option of issuer whether to convert the principal into shares or in cash. Here the principal amount is converted into equity, only the interest component is convertible into cash. When the bond are issued, the prevailing market rate for the similar debt without a conversion option is 9%. So market prevailing market rate is given is 9%. At the issue date, the market price of one ordinary share is rupees 3. Income tax is ignored. Entity has accounted for the convertible instrument using the principles of financial instrument. Interest rate is given, that is 6% for the year, has already been adjusted in the profit attributable to the shareholders. Now we have to calculate the basic and diluted EPS. Profit of attributable to the ordinary holder of the parent entity in year 1 is given, that is 10 lakhs. Ordinary share outstanding is given 12 lakhs, and convertible bond outstanding is also given, that is 2000. Now we have to calculate the basic and diluted EPS. Now we will calculate the basic EPS. Basic EPS is profit attributable to the ordinary equity holder of the parent entity in year 1 divided by 1 that is ordinary shares outstanding. In this case, 10 lakhs divided by 12 lakhs, so it becomes 0.83 per share. We have to check out the bonds details. Number of bond issued is 2000. Face value per bond is 1000. So face value of per bond is 1000. Total value of bond is 2000 into 1000. So it becomes 20 lakh. Interest rate is given in the question 6%. Interest component thereon is 20 lakhs into 6%. So it becomes 1,20,000 each year. That is the interest component. Market rate of similar bond is also given, that is 9%. Term of the bond is also given, 3 years. Now we have to determine the present value of the cash flows of the interest, that is 1,20,000 into 9% for 3 years. Present value of cash flows of interest component settled in cash, that is year 1, 2, 3 interest is, that is the coupon interest is 1,20,000 per present value factor at the rate 9%. So 1 divided by 1.09, so it becomes 0.91743 multiplied into 1,20,000, so it gives the present value of cash flows, that is 1,10,091.7. In the next becomes 1,20,000 into the present value factor, that is 0.91743 divided by 1.09, so it becomes 0.84168. 1,20,000 into 0.84168, so it becomes 1,01,001.6. In third year, it becomes 1,20,000 into present value factor at the rate 9%, so it becomes 0.772183. So it becomes 1,20,000 into 0.772183. So it becomes 92,662.02. So total present value of cash flows becomes 1,10,091.7 plus 1,01,001.6 plus 92,662.02. So it becomes 3,03,755. Now calculation of interest, that is year 1, 2, 3. Total interest becomes 3,03,755. Effective interest rate at the rate 9%. So it becomes 3,03,755 into 9%. So 27,338. Coupon payment is 1,20,000. 3,03,755 plus 27,338 minus 1,20,000. So it becomes 2,11,093.34. Now in year 2, 2,11,093.34 into 9%, so it becomes 18,998. Coupon payment is 1,20,000, so it becomes 2,11,093.34 plus 18,998 minus 1,20,000, so it becomes 1,10,091.7. Now in year 3, 1,10,091.74. Effective interest rate is 9%, so 9,908. Coupon payment is 1,20,000. So 1,10,091.74 plus 9,908 minus 1,20,000. So closing balance becomes nil. So this is the calculation of interest, but we only need the calculation for year 1 because we are calculating for year 1. So assumption, entity intend to settle only interest component in cash. So allocation of the proceeds of bond, total value of bond is 20 lakhs, and in that the interest component we had determined that 3 lakh 3,755 is the interest component. Liability component, that is interest component, 3 lakh 3,755. So in the equity component is 20 lakhs minus 3,03,755, it becomes 16,96,245. That is the equity component. The liability and equity component would be determined in accordance with Ind AS 32. Number of bonds converted into shares. Each bond is converted at any time up to the maturity into 250 ordinary shares. So present number of bonds are 2000 and each bond is converted into 250 shares. So 2000 into 250, so number of shares becomes 5 lakh. Now we have to calculate the diluted EPS. It is presumed that the issuer will settle the contract by issuing of ordinary shares. The diluted effect is therefore calculated in accordance with the standard, that is profit attributable to the ordinary equity holder of the parent entity year 1 plus interest liability component for the year 1 divided by ordinary share outstanding plus number of bonds converted into shares. Profit attributable to the ordinary holder of the parent entity is 10 lakhs plus the interest component for year 1. Here we had calculated in year 1 the interest component is 27,338. That is 10 lakhs is the normal profits plus interest component is 27,338 divided by denominator is 12 lakh, which is already in the question, that is the 12 lakh shares outstanding during the year plus the convertible shares are becomes 5 lakh. 12 lakhs plus 5 lakhs, so 10 lakhs plus 27,338 divided by 17 lakhs, so it becomes 0.60 per share. Now in this way we will calculate, give the effect of financial instrument in calculating the EPS. Now we will discuss about the written put option. Written put option is the contract that requires the entity to repurchase its own shares, such as written put option and a forward purchase contract, are reflected in the calculation of diluted earning per share if the effect is dilutive. If these contracts are in the money during the period, that is the exercise or settlement price is above the average market price for that period, the potential dilutive effect on earning per share shall be calculated as follows. Means it shall be assumed that at the beginning of the period, sufficient ordinary share will be issued to raise the proceeds to satisfy the contract. It shall be assumed that the proceeds from the issues are used to satisfy the contract, that is the buyback of ordinary shares, and the incremental ordinary shares between the number of ordinary shares assumed to be issued and the number of ordinary shares received from satisfying the contract shall be included in calculating the diluted earning per share. So concept written put option is explained with the help of examples. Suppose that an entity has 160 written put option outstanding on 160 of its ordinary shares with an exercise price of rupees 10 per option. 160 options are outstanding on 160 of its ordinary shares. An exercise price is 10 per options. The put obligation is therefore 1600 because 160 into 10, so it becomes 1600. The average market price of the entity's ordinary shares is rupees 8 per for the period. In calculating diluted EPS, the entity assumed that it issued 200 ordinary shares at rupees 8 per share. So we have to convert firstly 160 written put option outstanding on 160 of its ordinary shares with an exercise price of rupees 10 per option. Therefore, the total value of put option is 160 into 10, so it becomes 1600. The average market price of the entity's ordinary shares is rupees 8 per for the period. In calculating the diluted EPS, the entity assumed that it issues 200 ordinary shares at rupees 8 per share to raise the proceeds necessary to satisfy the put option. The difference between the 200 ordinary shares assumed to be issued and 160 ordinary shares that would have been received on exercise of the option, that is 40 shares, is added to the denominator in calculating the diluted EPS. No adjustment are made to the numerator because the shares are deemed to be issued for nil proceeds. So, in this case, what we denominator number of shares are increased. So total value of put option is 1600 and market average market price of the ordinary shares is 8. So number of shares issued is 200 shares, 1600 divided by 8. So 200 shares less number of shares received on exercise of option is 160. So free element is 40. That free element is added with the denominator while calculating the diluted EPS. And in numerator, there is no adjustments are to be made in numerator because the shares are deemed to be issued for nil proceed. Only in the denominator you will add the free element. Thanking you for watching my video. Please like, share.